Most property investors spend months planning their refurb. They track every cost, manage every contractor, then they go to refinance and the numbers come back way lower than expected. The mistakes that kill your refinance value aren't usually made during the refurb. They're made during the planning, the purchase, or the setup. Over the last 7 years, I've helped secure over 800 million in finance for property investors all across the UK. And as an investor with more than 20 properties myself, I've been on the other side of this too. So, in this video, I'll break down what every investor needs to understand about refinancing, the 5 most common mistakes that hurt refinance valuations, and how you can structure your deals to avoid them. Before we get into the mistakes, let's quickly break down how the refinance process works. Let's look at a typical BRR property strategy. This involves purchasing a property, refurbishing it, and then renting it out as a standard single let, a HMO or whatever exit strategy you've mapped out, maybe service accommodation, holiday let, etc. Let's say you've negotiated a good discount and bought the property for £100,000. You then spend £20,000 renovating it, and now the property's new value might be circa £150,000. Refinancing is the process of taking out a new mortgage against the property's new higher value and effectively releasing the equity that you've generated. This gives you a lump sum of cash which most investors will use towards their next property deal. But who exactly determines what the property's new value is? When you refinance, the lender instructs an independent RICS qualified surveyor, not you, not your estate agent, to value the property. The surveyor is working for the lender's interests, not yours. Their job is to establish what the property would realistically sell for on the open market based on comparable evidence. This means actual completed sales, not just asking price. This is both an art and a science because the market data matters, but so does the individual valuer's judgment. 2 surveyors can and sometimes do come back with different numbers on the same property. So let's look at all the mistakes you need to avoid beforehand to guarantee you get the best valuation possible. The first mistake, and one of the most common among newer investors, is overdeveloping for the street. Most streets have a ceiling price. It's the point beyond, regardless of what you've spent, comparable sales just don't support a valuation going any higher. The mistakes usually come down to poor due diligence at purchase, inflated expectations, optimistic end values not supported by true comparables, or emotional attachment to a target number before it's been stress tested. Before you model your numbers, look at what actually has sold on that street and the streets immediately around it. What's completed, at what price, in what condition. There's more technical versions of this worth noting too. If you have a HMO or semi-commercial asset sitting on a standard residential street, the wrong lender or valuer can default to a bricks and mortar valuation rather than an income-based one. That distinction alone can significantly reduce your refinance value, but we'll come back to HMOs specifically in a moment. The second mistake is failing to plan around what's known as the 6-month rule. This isn't law, more of a lending guideline, but it's a significant one. Many high street lenders won't lend on a property within 6 months of the previous purchase date. There are plenty of legitimate scenarios where you need to refinance within 6 months, like an uninhabitable property that's now being brought to mortgageable standard, or a below market value auction purchase. In these cases, the 6-month rule can become a real problem if you haven't planned for it. The key is knowing which lenders operate outside this guideline. For example, quantum mortgages will refinance from day one on an open market value, even with no works completed. Foundation home loans will refinance on day one on auction purchases. Aldermore operate on a day one basis with no schedule of works required. And fleet mortgages will refinance day one with supporting documentation like before and after photos, a schedule of works and proof of invoices. These products exist. Most investors just don't know about them until they're already stuck. And by then, the bridging costs are ticking. If you're weighing up a property deal at the moment, but want to make sure you're getting the best finance products available, you can book a free call with me using a link in the description. We can talk through your investment strategy, your upcoming deals, and the best next steps for you to take to finance them. Refinance mistake 3 is short leases, and this is one that catches out flat buyers in particular. Most lenders won't touch a property with a lease under 85 years. Different lenders have different minimums, but one trend is consistent. A short lease reduces your pool of available lenders and reduces the value they're prepared to lend against. Lease extensions cost money, and they become progressively more expensive as the lease shortens, especially below 80 years. But an extension also adds value, often substantially more than it costs. So the question isn't whether to extend before you refinance. The answer is almost always yes. The question is how you factor that cost into your business plan. If you're buying a flat with a lease under 85 years, price in the extension at purchase. Understand the timeline, it takes months, and make sure the extension is in place before you approach the refinance lender. Hoping a lender will work around a short lease is rarely a strategy that ends well. Mistake number 4 is a big one, and I've seen it happen a lot. A new investor completes a full refurb on what they believe is a strong HMO, fully finished, tenanted, cash flowing. They move to refinance. The surveyor flags it immediately. The property is in an area of Article 4 with no valid C4 or sui generis use class approval, or the HMO license is missing or incorrect. The lender either downvalues the property to standard residential, wiping out the premium, or declines the deal entirely. The refinance value doesn't materialise, you can't pull the planned equity, you end up sitting on an expensive bridging loan with capital stuck in the deal. This happens because investors assume that a functioning HMO is a compliant one. It often isn't. If the correct use class isn't in place, you don't have an HMO in the eyes of a surveyor. You have a residential property that's been legally converted. The fix is straightforward. Confirm Article 4 status before you buy, get the use class right, get the HMO license in place, align your exit strategy with the planning status of the asset from day one. If the use class isn't right, your entire refinance strategy can collapse, no matter how good the numbers look. The final mistake, and this can catch even more experienced investors out, is underestimating what a personal to limited company transfer actually involves. Moving property into a limited company SPV is increasingly common and makes sense for many portfolios. The structure is cleaner for scaling and there are tax advantages worth having, but investors treat it as a restructure, admin, paperwork. It isn't. It's a full transaction. The company is buying the property from you at open market value, even though you own both sides. That means 2 sets of solicitors, a new valuation, full lender underwriting, stamp duty being paid, and potential capital gains tax on the personal side. If you're overestimating the property's value or the market has moved since you bought, the transfer may not release the equity you're expecting. Get all the tax and accountancy advice you can before and go into it knowing that it's a full transaction, because that's exactly what it is. So now you know the most common mistakes to keep an eye out for. The investors who consistently pull strong refinance values are the ones who build the exit into the strategy from the very start. If you're looking to fund a property deal but want to make sure you're getting the best finance products available, don't forget you can book a free 30-minute call with me using the link below and I'd be happy to help. Before you get to the refinance process, you need to purchase the property first. So if you're weighing up a buy-to-let property as your next investment, before you do anything else, make sure you watch this video next.